Burry's most recent investment call has sent shockwaves all across the stock market and has everyone speculating on why he's made such a daring decision. He's sold all but one of the stocks he owns in anticipation of a possible massive crash in the US stock market. While Burry is known for almost always going against the general trends on Wall Street, his most recent call is especially shocking. Are we about to see a repeat of the subprime mortgage crash all over again? Or how spot on can Burry be this time around? Stick around as we explore the reason behind Burry's recent shocking decision and just what could follow in the stock market. Michael Burry is no novice in the world of stock investment. He is famed for being one of the earliest investors to predict and make tremendous gains from the subprime mortgage crisis that shook the global economy between 2008 and 2010. His exceptional brilliance and success in his stock picks, which Burry himself attributes to his traditional understanding of value, have earned him a rather occult following on Wall Street, and has even been depicted in a 2015 movie called The Big Short. While many Wall Street investors still consider the medium-term outlook of the US economy to not be as turbulent as feared several weeks ago, Burry is taking no chances and has chosen to make the biggest gamble of his investment career. While US inflation slowed notably in July, being a possible indication that it's finally reached a peak point, many Wall Street investors are already eyeing the possibility of the Federal Reserve being less aggressive in its rate hikes going forward. Burry, from his recent massive stock sales, is clearly keeping away from the flock and appears to be positioning himself for a bigger opportunity that many other investors are yet to identify. Like many economists have already warned, the already roof-high interest rates could precipitate a hard landing for the economy. Burry appears to be aligning with this view and has made the rather puzzling decision to sell the bulk of his stock holdings based on his anticipation of a crash. From his recent statements, he's very convinced that the worst is still to come, and that many households may soon be exposed to a huge debt crisis which could further spell doom for the economy. U.S. consumer borrowing increased by $40 billion in June alone, being the second biggest increase ever in a single month, and just $7 billion short of the highest increment earlier in March 2022, according to data from the Federal Reserve. Consumers are increasingly appearing to be unable and unwilling to cut back on spending, especially in the face of fast rising prices. According to Burry, the COVID-induced injections have taught people to spend again, and now it's become very addictive. This addictive spending habit has completely wiped out the savings glut that existed pre-COVID, and has greatly depleted the savings of many American households. To Burry, many Americans are putting themselves in a delicate financial situation, especially as inflationary pressures persist and rising prices continue to be a drag on the economy. Burry believes that the combination of over-leveraged households and decreasing real personal income spells nothing but doom for the economy, especially with its potential not just to weigh on consumer spending, but to also greatly deplete earnings by companies. Real personal income, going by available data, has grown by 0% in 2022. And all of these underlying issues, in Burry's view, are precursors to a looming credit market disaster. While the job market still appears strong, Burry is convinced that it's actually in a state of decline, and that weakness in the job market would result in a further decline in real income, which is historically correlated with returns on the S&P 500. This unbridled household cash burn continued into July, with credit and debit card spending, which traditionally account for over 20% of total payments in the US, rising by 8%, while card spending per household likewise moved higher by 5.3%. As Burry had already forecasted, recent data released from the Empire State Manufacturing Index confirms his prediction about the state of the jobs market. With the index missing expectations by a wide margin and being printed at a negative 31.3, its lowest level since 2009, the job market as predicted by Burry clearly appears to be in a state of decline. The NAHB Housing Index data, which is negatively correlated with the U.S. unemployment rate, has likewise dropped to its lowest level following an 8-month consecutive declining trend. Burry has now given the strongest confirmation of his pessimistic outlook of the U.S. economy with his filing with the SEC on August 15th. As per Burry's filing, his firm, Scion Asset Management, has liquidated its entire portfolio of U.S. stocks as far back as the 30th of June. As things stand, Burry now only owns slightly over 500,000 shares of Geo Group, a company that invests in private prisons and which is worth about $3.3 million. Geo Group presently has a market capitalization of $943 million. And as soon as the news of Burry liquidating his stock portfolio hit the headlines on August 15th, the company saw its shares jump by nearly 11% during the trading session for the day, before going on to increase 20.8% during the week. Before Burry took this puzzling decision, he had large investments in a total of 11 U.S. companies, including some of the biggest names on Wall Street. Burry, through his firm Scion Asset Management, had investments in Alphabet, Google's parent company, Meta, the parent company of Facebook, Instagram, and WhatsApp, and even held a bearish position on Apple. In fact, back in March 2022, Geo Group was not on the list of companies that Burry had investments in, making the company a new addition to the list. If not for stock market regulations that require fund managers with more than $100 million in equities to file a 13F form that lists their stock holdings on U.S. exchanges within 45 days of the end of the last quarter, Burry's recent move might not have come into public knowledge. While this is not the first time that Burry has resized his U.S. stock holdings, the scale of this recent resizing is rather unprecedented. Going by available records, the seasoned investor similarly in the third quarter of 2021 reduced his portfolio from 20 holdings to 6 only in the space of 3 months. Burry is obviously putting his money where his mouth is as regards his prediction of a possible market crash. But the puzzling question among lots of investment analysts on Wall Street at the moment is if the famed investor sold too soon. Before the news of his extremely bearish stance made headlines, Burry had always shared what many Wall Street analysts consider to be extreme bear market beliefs across social media platforms, especially Twitter. And just 3 days before the recent big announcement, Burry laid bare his pessimistic view of the market in yet another of his tweets, where he wrote, "Nasdaq now up 23% off its low. Congratulations! We now have the average bear market rally. Across 26 bear market rallies from 1929 to 1932 and 2000 to 2002, the average is 23%. After 2000, there were 40% plus bear market rallies and one 50% plus rally before the market bottomed. While the third quarter began with the market rallying considerably and proving to investors that the stock market is still able to recover even in the face of the harshest macro environments, Burry is unmoved and has opted to follow through on his bearish beliefs. Going by the available data, on July 1st, when the third fiscal quarter began, the SPDR S&P 500 ETF Trust gained 11.48%, and the SPDR Dow Jones Industrial Average ETF Trust also gained 9.4%. But despite all of this, Burry has demonstrated a complete lack of faith in the stock market as a whole, and his recent portfolio resizing echoes this sentiment. While macroeconomic conditions in the economy appear to be setting up for a possible bottom dropout moment in the markets, earning estimates since the turn of the third quarter are trending upwards, in what an investor like Burry considers to be an anomaly. The reasons for Burry's recent bearish move remain unclear, and might well just end up being inconsequential. Burry is evidently comparing the equity markets of 2000 and 2008 to what's obtainable presently, and his outlook appears to be that not much has changed. Now, the question is whether this is the state of another 2000-2008 period, or merely just another 2018 scenario. Make sure you give this video a like, hit the subscribe button, and smash the notification bell to receive updates on when we post more intriguing stories about global finance and investing.